What if I told you there are 3 stocks trading for less than the price of your morning coffee that could potentially multiply your investment several times over? I'm not talking about worthless pump and dump schemes or companies with no real business. I'm talking about legitimate publicly traded companies with real revenue, real products, and massive growth catalysts on the horizon. Today, I'm going to reveal 3 stocks under $3 that institutional investors are quietly accumulating while retail traders are completely overlooking them. These aren't your typical penny stocks. They're operating in some of the hottest sectors in the market right now, and by the end of this video, you'll understand exactly why these could be massive opportunities. Hey everyone, welcome back to the channel. If you're new here, I focus on finding undervalued opportunities in the penny stock market, and today's video is going to be packed with actionable information. Over the next 15 minutes, I'm going to break down 3 stocks trading under $3 across 3 completely different high-growth sectors. I've done the research, analyzed the fundamentals, looked at recent catalysts, and I'm going to share everything you need to know. But before we dive in, I need to make something crystal clear. These are high-risk, speculative investments. Penny stocks are volatile, and you should only invest money you can afford to lose completely. This video is for educational and entertainment purposes only, not financial advice. I'm not a licensed financial advisor, and you need to do your own research before making any investment decisions. With that said, if you find value in this content, do me a favor and smash that like button. It really helps the algorithm push this video to more people. And if you're not already subscribed, hit that subscribe button and turn on notifications so you don't miss future videos where I break down more penny stock opportunities just like this. All right, let's jump into our first pick. The ticker is TLRY, Tilray Brands, and it's currently trading around 80 to 90 cents per share. Now, when most people hear about a cannabis stock, they immediately think it's just another weed company trying to capitalize on legalization hype. But Tilray is completely different, and that's exactly why it made this list. This isn't just a cannabis play, it's a diversified lifestyle brand with 2 major revenue streams that hedge against each other. Tilray operates in both the cannabis industry and the beverage alcohol industry, which means when one sector faces headwinds, the other can help balance things out. This is a NASDAQ-listed company with international operations spanning Canada, the United States, and Europe. So we're not talking about some sketchy over-the-counter stock with questionable financials. Let me break down their business model because this is where it gets really interesting. On the cannabis side, Tilray cultivates and sells both medical and recreational cannabis products. They have cultivation facilities, processing operations, and distribution networks already established. But here's where they differentiate themselves. They also own multiple breweries and craft beer brands in their beverage alcohol division. Think about the strategic genius of this for a second. They've built expertise in regulated industries, they understand compliance, they have distribution channels, and they've created a portfolio approach that gives them stability. When cannabis faces regulatory challenges or market saturation, their beverage business keeps generating revenue. When alcohol sales face pressure, cannabis picks up the slack. This diversification is something most penny stock cannabis companies simply don't have. If you look at their revenue breakdown, you'll see meaningful contributions from both divisions. And they've been actively expanding their brand portfolio in both categories. Their geographic footprint is also crucial here. They're not just relying on one market. They're positioned in Canada where cannabis is federally legal, they're making moves in the US market within the legal framework, and they're expanding in Europe where medical cannabis is gaining significant traction. Now let's talk about why this stock is compelling right now, because timing is everything in penny stocks. First major catalyst, cannabis rescheduling in the United States. The DEA has been reviewing cannabis classification, and if cannabis gets moved from Schedule 1 to Schedule 3, it opens up massive opportunities for companies like Tilray. We're talking about banking access, tax benefits under 280E, and legitimization of the entire industry. This has been building momentum, and if it happens, Tilray is positioned to benefit significantly. Second catalyst, European expansion. The European cannabis market is still in its early stages, and Tilray has already established operations there. As countries continue to legalize medical cannabis and eventually recreational use, Tilray has first mover advantage in multiple markets. Germany recently made major moves toward legalization, and that's one of the largest economies in Europe. Third catalyst, their beverage portfolio growth. They've been acquiring craft breweries and building their alcohol brand presence, which gives them alternative revenue growth, even if cannabis faces temporary slowdowns. Now here's what really gets penny stock traders excited, the volatility. This stock hit a 52-week high of $1.99, which means from current prices, around 80 cents, you're looking at potential for 2 to 3x returns just to get back to recent highs. We've also seen volume spikes recently, which often indicates institutional accumulation. When you see unusual volume in penny stocks, it usually means something is happening behind the scenes. But let's be real about the risks here, because I'm not going to sugarcoat anything. Cannabis stocks are notoriously risky. Regulatory uncertainty is the biggest concern. If rescheduling doesn't happen or gets delayed, the catalyst disappears. Dilution is another major issue in this sector. Cannabis companies often need to raise capital, and they do it by issuing more shares, which dilutes existing shareholders. Tilray has done this in the past, and they might do it again. Competition is fierce in both cannabis and beverages. These are crowded markets with thin margins. And there's currency risk since this is a Canadian company reporting in Canadian dollars, so exchange rates can impact returns for U.S. investors. The bottom line on Tilray? This should be a small, speculative position in your portfolio, maybe 2 to 5% at most if you're aggressive. This is best suited for investors who are bullish on cannabis legalization trends and like the idea of a diversified business model. Analysts have various price targets on this, ranging from $1 to over $2, depending on their outlook for the cannabis industry. If you're going to play this, I'd suggest watching for volume confirmation and maybe scaling in rather than going all in at once. Set a stop loss to protect yourself if things go south. Now let's transition to our second pick, which takes us into the clean energy space. Stock number 2 is ticker PLUG, Plug Power, currently trading around $1.98 per share. If you've been following the clean energy revolution at all, you've probably heard about hydrogen being the future of transportation and power generation. Plug Power is essentially the picks and shovels play in the hydrogen economy. While everyone else is talking about hydrogen, Plug Power is actually building the infrastructure to make it happen. This isn't just a fuel cell manufacturer. They've created an end-to-end green hydrogen ecosystem, which means they're involved in every step from production to storage to end use. That vertically integrated approach is incredibly valuable because it means they're not dependent on any single part of the value chain. Let me explain their business because hydrogen technology can sound complicated, but the concept is actually pretty straightforward. Plug Power makes hydrogen fuel cells, which are devices that convert hydrogen into electricity. They also manufacture electrolyzers, which produce hydrogen by splitting water using electricity. Then they have storage and distribution systems to get that hydrogen where it needs to go. Their target markets include material handling, think forklifts and warehouse equipment, e-mobility, which is basically hydrogen-powered vehicles, and stationary power generation for backup power and grid support. The big picture vision here is that Plug Power is building the hydrogen highway. Just like gas stations exist for traditional vehicles, Plug Power is creating the infrastructure for a hydrogen-based economy. And here's what gives this credibility. Their customer base. We're talking about Amazon, Walmart, and other Fortune 500 companies already using their technology in warehouses and distribution centers. These aren't speculative customers, they're actual deployments generating actual revenue. So why is this stock interesting right now? Let's go through the major catalysts that make this compelling. First, and probably most important, Plug Power just closed a $431 million convertible notes offering. That's a massive cash injection that gives them runway to continue operations and infrastructure build-out. In the penny stock world, when a company secures major financing, it often signals confidence from institutional investors and provides the capital needed to execute their strategy. Second catalyst, government support for hydrogen. The Inflation Reduction Act in the United States provides significant subsidies and tax credits for clean hydrogen production. We're talking about potentially $3 per kilogram in credits, which dramatically improves the economics of Plug Power's business model. This is the government essentially subsidizing the hydrogen economy into existence, and Plug Power is positioned to be a major beneficiary. Third catalyst, we're in the infrastructure build-out phase. The hydrogen economy requires massive infrastructure investment, and that spending is happening right now. Plug Power is building production facilities, expanding their electrolyzer capacity, and signing partnerships globally. This is the early innings of what could be a multi-decade trend. Now, let's talk about the stock's price action, because this is where it gets really interesting for traders. Plug Power has extreme volatility with a 52-week range from 69 cents to $4.58. Think about that for a second. If you had bought at the absolute bottom, you'd already be up nearly 3 times your money. The stock is currently at $1.98, which is closer to the middle of that range. That means there's potential upside back toward the highs, but it also means this stock can swing wildly in both directions. We're seeing growing hydrogen demand globally as countries commit to net zero emissions targets. Europe is especially bullish on hydrogen, and Plug Power has international expansion plans to capture that demand. But here's where I need to pump the brakes and talk about the significant risks with this stock. Path to profitability is still unclear. Plug Power has been burning cash, and while that $431 million raise helps, They need to demonstrate they can actually make money. Cash burn rate is a major concern. If they run through this capital without achieving profitability, they'll need to raise more money, which means more dilution. Competition is heating up from battery electric solutions. Tesla and others are betting on batteries instead of hydrogen for vehicles, and that creates uncertainty about which technology will win. The stock has been an absolute roller coaster, and if you don't have a strong stomach for volatility, this will shake you out at the worst possible times. And remember those convertible notes? When those convert to shares, that's dilution that will pressure the stock price. My take on Plug Power? This is a high-risk, high-reward momentum play. You need to be comfortable with the possibility of this going to zero, but also understand the upside if hydrogen economy thesis plays out. This is best for aggressive investors who are willing to bet on the hydrogen economy becoming mainstream. If you're playing this technically, watch for support around 150 and resistance around 250. Set alerts and have a plan. Now let's move to our third and final pick, which takes us into the traditional energy sector. Our final stock is ticker RIG, Transocean, currently trading around $3.85 per share. Now I know this is slightly above our $3 threshold, but it's close enough, and the opportunity is too good to ignore. When oil companies need to drill in the deepest, most challenging waters on the planet, they call Transocean. This is the world's leading offshore drilling contractor, and they have a technological edge in ultra-deepwater drilling that gives them pricing power. While renewable energy gets all the headlines, the reality is we still need oil and gas, and offshore drilling is a critical part of that supply chain. Transocean owns and operates the most advanced fleet of offshore drilling rigs in the world. Let me give you context on their business model because it's different from oil producers. Transocean doesn't own oil fields or sell oil. They own the rigs and rent them out to oil companies on contract. This is a contract-based business model which provides more predictable revenue compared to pure commodity exposure. They have ultra-deepwater drill ships that can drill in water depths of 10,000 feet or more, and harsh environment rigs designed for places like the North Sea where conditions are brutal. The key metric to watch with drilling contractors is day rates. That's how much they charge per day to rent their rigs. When oil prices are high and drilling activity increases, day rates go up dramatically. Transocean has secured $2.4 billion in backlog, which means they have contracted revenue already locked in. They have industry-leading contract coverage extending through 2026, which gives visibility into future cash flows. If you look at a map of their global operations, they're everywhere. Gulf of Mexico, Brazil, West Africa, Norway, Australia. This geographic diversification protects them from regional downturns. The catalysts for Transocean right now are compelling, and this is why the stock has been moving. First catalyst, they just secured $89 million in new offshore contracts. Every contract announcement like this adds to the backlog and signals continued demand. Second catalyst, the stock is up 26.7% over the past month. That kind of momentum in a penny stock often continues as more traders notice and pile in. Third catalyst, oil prices have been elevated and drilling activity is increasing globally. When oil is at $80 to $90 per barrel, offshore projects that were uneconomical at $50 suddenly make sense. Oil companies are greenlighting new projects, and that means demand for Transocean's rigs. Fourth catalyst, industry consolidation is reducing competition. Several smaller drilling contractors have gone bankrupt or merged, which means less competition and better pricing power for survivors like Transocean. The supply-demand dynamics favor offshore drilling right now because years of underinvestment have created a shortage of high-quality rigs. Day rates across the industry have been improving, and Transocean's premium rigs command premium pricing. Now let's address the risks, because this isn't a perfect story. Transocean has a debt-heavy balance sheet. They took on significant debt during the oil downturn, and while they're managing it, it's still a concern. This is a cyclical industry that's completely dependent on oil prices. If oil crashes back to $40 per barrel, drilling projects get canceled and Transocean suffers. Energy transition is a long-term headwind. As the world moves toward renewables, offshore oil drilling faces structural decline over decades. That doesn't necessarily hurt near-term returns, but it's something to consider. Geopolitical risks can impact their operations since they work globally, and political instability or regulatory changes in key regions could hurt business. My verdict on Transocean? This is actually the most established of our three picks today. It has the longest operating history, the most proven business model, and arguably the lowest risk profile. This is best for investors who are bullish on the oil cycle continuing for at least another couple of years. Near-term catalysts include contract announcements and potential day rate increases, which could drive the stock higher. If you're looking at this technically, there's support around 320 and resistance around 450 based on recent trading. This has less explosive upside than the other two picks, but it also has more stability. Let's do a quick recap of all three stocks we covered today. Stock number 1 was Tilray Brands, ticker TLRY, trading around 80 cents. This is your cannabis and beverage diversification play with catalysts around U.S. rescheduling and European expansion. Stock number 2 was Plug Power, ticker PLUG, at around $1.98. This is your green hydrogen infrastructure bet with recent major financing and government support as tailwinds. Stock number 3 was Transocean, ticker RIG, at $3.85. This is your offshore drilling recovery story benefiting from higher oil prices and new contracts. 3 different sectors, 3 different risk profiles, but all trading under or very close to $3 per share. The beauty of these 3 picks is diversification. If you were to take positions in all 3, you're spread across cannabis, clean energy, and traditional energy. That diversification reduces your risk compared to betting everything on one sector. Here's my final thought on position sizing and risk management, because this is crucial. These should be small positions in a diversified portfolio. I'm talking about 2 to 5% maximum in each position if you're aggressive, maybe 1 to 3% if you're more conservative. Don't put all your eggs in one basket, and definitely don't bet money you need for bills or emergencies. Have exit strategies planned before you enter. Know where you'll take profits and where you'll cut losses. Stop losses are your friend in volatile penny stocks. Set them at levels that make sense for your risk tolerance, maybe 10 to 20% below your entry, depending on the stock's volatility. These stocks can gap down on bad news, so mental stops aren't enough. Use actual stop-loss orders. And remember, volatility works both ways. These can double or triple, but they can also get cut in half. That's the nature of penny stocks.